The idea here that the Fed appears to be ready to move despite some of the hiccups in the economy here. I guess the question here is, are you comfortable with that? If the Fed does start to move, I guess when they said it was going to move.
Hi, Romaine. How are you?
Yeah.
Great to see you. Yes, we think that the comments today are consistent with what we thought earlier, which is they're going to raise rates towards the end of 2022, definitely 2023. So right now, our position is we really like stocks over bonds for obvious reasons, and we're focused more on the U.S. Our clients, who typically live in the Midwest, many of whom are business owners, all of them are invested in the equity markets. They're concerned about beating inflation. We can't do that right now in this low interest rate environment. Hence, the reason why we prefer stocks over bonds. Otherwise, our clients have negative purchasing power. Second, our clients are concerned about taxes. So we're trying to be very strategic with how we're investing the portfolios.
Okay, strategic to ensure that you're sort of making the most of the tax environment, Jill. But I'm interested when you've got stocks at these sorts of levels, these valuations. Yeah, it's a bit of a down day, but still very elevated. Are your clients worried about getting in at this point?
They're worried, but it's also a great opportunity for us to dollar cost average out. And we're really emphasizing that. We think that higher taxes are on the horizon. We do think that there's a lower risk of capital gains tax rates increasing retroactively as of April 28th, as an example. So we do want our clients to grab income, take gains while the market is at its peak.
Does this grabbing income theme, Jill, that you so eloquently write in your note, sort of persist with this idea of risk-taking, of excess risk-taking?
Great question. It depends on the client's goals and objectives. I'll go back to what I said earlier. Right now, we're in a very challenging rate environment. So for our clients to be comfortable with stocks, and again, we can take defensive positions there, we can accomplish their goals. And we think that the equity markets still have a long time to run.
All right, let's talk about a little bit more long-term here, Jill. I mean, obviously, the Fed is going to do what it does. We are actually awaiting, I guess, word here on additional fiscal spending out of Washington here. Not only that infrastructure bill, but, of course, the more broader infrastructure ambitions of the Biden administration. How does that factor into your general outlook here for economic growth and I guess, for the markets?
Our equity team is watching that very closely. And again, we think there will be a sliding scale based on where the fiscal policy comes in, how many trillions that will affect the market. So again, right now, we're really focusing on making sure clients are positioned appropriately based on their goals and objectives. And we still really like big tech. We have a very healthy appetite for that. We're also continuing our post-recessionary positioning.
Big tech. Jill, I mean, the earnings have been phenomenal, but not as phenomenal for some as they'd anticipated. I mean, what's the attraction of going into the companies that have so outperformed throughout 2020, not alone as well 2021?
I think what we've seen is a number of these companies are very adaptable. We saw that through the pandemic, and we think they will continue to be very adaptable. And their earnings will go along with that, and they'll continue to see nice increases in their prices. Of course, I think the unevenness of the recovery, and that's something I want to emphasize, lends itself to making sure that clients not only have a healthy exposure to tech, but we have broadly diversified portfolios. And again, taking advantage of these risk-on, risk-off days to dollar cost average in or out, depending upon goals and objectives.
Jill, my co-anchors won't forgive me for asking this question. Within that diversified portfolio, you indeed see room for muni bonds, don't you?
We do. As I mentioned earlier, tax rates are very likely going up. They could be going up next year. We certainly know after the expiration of the Tax Cuts and Jobs Act, they'll be going up. So clients are looking for tax-advantaged investments, and munis certainly have a place there, and they'll be very valuable.